Alrighty, Business 163. Here is our fifth and last video in this module on housing. Just to give you an introduction to the whole topic of mortgage loans. And this is a pretty big topic. So this is only going to give you sort of a basic introduction. There's a lot of stuff here that you may want to explore if this is really something that you are looking to do, to buy a home in this near future and looking to apply for a mortgage loan. But I'm here I just want to give you some basic categories to start thinking about as we describe some of the options and some of the basics and fundamentals of mortgage lending here in the United States right now. Alrighty, so as you can see from the title slide, this last fifth video is about mortgage loan basics. Well, we've talked about getting pre-approved, but what we really haven't yet talked about is what types of loans are out there. Some of the considerations when we talk about different types of loans, we can talk about different types of loans, well, of course, in terms of the loan amount. The loan amount, of course, relative to the home price and your down payment leads then to the whole issue of loan to value ratio, okay? And let me just explain that quickly. Let's say that you are looking at a home to purchase that is, for instance, $400,000, and you are going to put 10% down. Well, if the home is worth $400,000 and you're putting 10% down, that's $40,000, right? Yeah, the math is actually pretty simple. Okay, which means you are borrowing how much? $360,000, right? You're putting down 10%. You're borrowing the other 90%, that's $360,000. Well, that's a loan to value ratio of 90%. Putting down 10%, borrowing 90% of the sales price, right, to close escrow, to purchase the home, right? Now, you can put down, well, with conventional loans as little as 5%. There are other loan programs that do allow up to 100% financing, but let's say you're going to put down a 5% down payment versus someone who is planning to put down a 30% down payment. Same house, $400,000 sales price, right? So with a $400,000 sales price, the person who's looking to put 5% down, well, that's $20,000 worth of down payment, right? Versus with a $400,000 sales price, the borrower who's looking to put 30% down is looking to put down $120,000, right? Now, here's the question. Why is this whole LTV business so important? Well, from a lender's perspective, if borrower A is putting down 5%, $20,000, and borrower B is putting down 30%, $120,000. If things really go difficult and bad for those borrowers, let's say they temporarily lose their jobs or have a big financial setback, who's going to work harder to make the loan work, to keep making the payments? Well, frankly, the person who has more equity in the deal, the person who's put 30% down, because if that house is foreclosed on, they're going to lose $120,000 they already put into the house, right? Versus the person, if they lose the house, right, they'll lose, well, $20,000, which still is nothing to sneeze at, but $20,000 is not $120,000. Hope you get my point, right? The whole point is that the lower the LTV, the lower the loan to value ratio, the safer a loan it is from a lending perspective, the more amenable I am as a lender to approve that loan if they're putting more money down. Okay, so returning to the slide, what's next? Well, there's the term of the loan, which might be as short as, say, 10 or 15 years or as long as 30 years. What's the interest rate? And quite frankly, is that the interest rate that's going to stay for the duration of the loan, or will it change over the life of the loan? And that leads to the next question. Is this the type of loan that has a fixed interest rate or an adjustable rate or something in between? Now, what do I mean by something in between? When you look at the diagram I've given you on the right, you see there 30-year fixed, 15-year fixed at the top, but you see that little yellow hexagon that says 5-1 ARM? What's a 5-1 ARM? Well, a 5-1 ARM is an adjustable rate mortgage. However, when it says 5/1, it means the first 5 years of that loan the interest rate is fixed at some relatively low amount, and then in the 6th year it turns into an adjustable rate mortgage. This gives you the advantage of having both a lower introductory interest rate for the first 5 years of the loan and a little bit of time where it's a fixed rate, at least 5 years where it's a fixed rate before it turns adjustable. Now, of course, when you're contemplating an adjustable rate mortgage, the whole question is, well, in the 6th year, what will prevailing interest rates be? And there's no guarantees on that, right? And so that's where the uncertainty and risk comes into the picture. There are other considerations. Is the loan amount what we call conforming, or is it larger than conforming? These, of course, are technical terms. You can read more about them as we give you more information on the details of mortgage loans, right? What's the size of the loan? Jumbo loans have slightly higher interest rates because the loan amounts are larger, therefore the lender has more risk. Or you see at the bottom of this diagram, FHA, VA, Fannie and Freddie, and USDA. Those are all government agencies or large institutional agencies that have that provide either backing or insurance for mortgage loans to provide some advantages to certain types of buyers, sometimes first-time buyers, sometimes moderate income buyers, or in the case of VA loans, folks who have served or are serving in a branch of the U.S. Armed Forces or are no longer serving in the armed forces but have been satisfactorily discharged. Those are different permutations, but as you can see, there's a lot of different variations in mortgage loans out there. And so rather than go through great detail on each of the different types of loans, we would simply suggest to you there are lots of options out there, and quite frankly, there always have been, right? And really, the best advice I can give you is to talk to a mortgage professional that you can trust to help guide you through some of these options and what might fit for your particular life and career situation, right? I am not the type of person who would say you should never, ever, ever get an adjustable rate mortgage. No, I would never say that. I would simply say, if you're going to contemplate taking on a adjustable rate mortgage, you should know exactly how that loan operates and what the risks are, okay? There are absolutely certain cases where it might make sense to contemplate an adjustable rate mortgage. There are many other cases where, quite frankly, you should probably stay away from that kind of a mortgage loan, stick with a fixed rate product, right? Now, the worst match of all, bar none, is taking on a mortgage loan that you do not understand. If you don't understand how it works and what the terms are, if you haven't done your homework, well, shame on you. That's going to be a bad match, no matter what the loan is, right? You need to do your homework, and at least now you sort of know what the big contours are of different mortgage loan products for you to be asking questions about. Again, this is the kind of thing that it's difficult to give you an enormous deep education in one single video lecture. If you have questions, certainly feel free to ask me. I spent almost an entire decade in the mortgage industry, and I'm happy to walk you through some of the consequences as well as the implications of certain types of mortgage loan products, things you ought to be thinking about. Happy to do that for you as a student in this course, but at least we can give you the generalities here in this lecture. All right. What else should you know about mortgage loans? You should know how mortgage loans work from the application to approval. Generally speaking, when you submit your loan application with your accompanying paperwork, which would include things like pay stubs, tax returns, bank statements, etc., realize that your loan application is primarily going to be based upon 4 factors. Now, we already know, of course, that loan to value matters, but that's not really an aspect of your application, right? So what are we looking at as mortgage lenders when we consider who you are as an applicant? Number one, we're looking at your income, your history of earning income, and your employment stability, or I guess should we call it more specifically, the stability of the income you're receiving. right? And generally speaking, what we're looking for is for your monthly housing payment, which includes not only the principal and interest portion, but also taxes and insurance. We factor that into the number as well. So that principal, interest, taxes, and insurance should represent about a third of your take-home income. Take home, that means after taxes, all right? So calculate your take-home income. Your housing payment should be roughly about a third of that and no more, all right? So that's really sort of the guide we're looking for. And of course, we want your employment to be stable enough to reasonably be able to count on that employment and that income continuing into the duration of your loan. That's number one. Number two, we want to consider, what about the assets? The assets that, well, one, will form the money that you're going to use to make your down payment, as well as to pay for any closing costs, as well as, do you have reserves after you make all of those payments? Do you have additional cash, savings, investments that you can count on, that we can count on as a lender if things sort of go sideways for you? Will you be able to continue to make the mortgage payments while you get your life turned around, so to speak, right? So that's the second thing, your level of liquid assets. Number three, we're looking at your credit history, and of course your credit score. And nowadays, of course, mortgage loans are approved to a very high degree with automated underwriting by the algorithm. And therefore, what we're really interested in is your credit score. Your credit score will impact not only the interest rate that we are willing to offer to you as a lender, it's also going to impact whether or not you get the loan to begin with, right? So you need to make sure you've done everything possible to get your credit score as high as you reasonably can before you apply for the loan. And finally, the last consideration after income and employment, your assets, your credit score and history, will be the house itself, the collateral that we will be accepting as a lender to provide for the collateralizing the loan if we, if things go bad, you stop paying the loan, we got to foreclose on the house. What is the house? Is the house worth the sales price? Does it really, the value of the home support the loan to value ratio that I'm counting on as a lender? All of these things are crucially important, right? Therefore, just know, as you prepare to submit your loan application, realize that this is how your loan will either be approved or not, is the lender's consideration of your income and employment, the assets you have for the down payment, closing costs and reserves, your credit score and credit history, and the collateral, the home itself that you are looking to purchase. That's generally how a mortgage loan works, at least how the application works, right? Again, as you look to go on your home buying journey yourself, you should talk to a qualified mortgage loan officer to really get the lowdown on how your particular personal circumstances work with the loan application. All good mortgage professionals be happy to chat with you to give you guidance and suggestions how to maximize your chances of your application being approved as quickly as possible and as pain-free as possible to make that part of the home buying process a no-headache kind of affair. Alrighty? So, this is our very last video in this series on housing. I hope this has been helpful for you to at least demystify a little bit of the process, right? Again, the reason we give this to you is why? Because whatever you choose, whether you choose to rent or to buy, typically our housing expenditures are the very, very biggest part of our regular budget, our regular financial plan, and therefore should be given specific and careful attention before we decide to move forward, well, with any choices that we decide to make. Hope that's helpful. This provides then a little bit of an introduction to the whole topic of housing. We'll see you in the next module.